Hello, everyone, and welcome to this 9th edition of the Voyage. So like every year, we present our views on the market outlook and how do we see things going forward. So this year, the theme is India navigating with resilience. I mean, year 2022 has been a very eventful year, I would say. If anybody had told you at the beginning of the year that you would see the US 10-year at around 2.6, you would expect around 7 to 8 rate hikes in this calendar year in the US. And oil will be at around $110, $120. And you would have a war breaking out across the world. Where would the markets be, right? So, I mean, we saw all these things happen in the last 3 months, and the markets did correct. We saw around 12 to 15% correction across the Indian and the global markets. But the markets have been fairly resilient and they have bounced back. And if you look at as we stand today, the S&P is down by just around 5% from its peak. Indian markets are down around 3 to 4% from its peak. So while all the negative news which has been there, the markets have been fairly resilient. So does that mean that everything is hunky and dory? I mean, everything is fine. So let's look at what has changed, okay, since we started at the beginning of the year. So every year we do an analysis on a market outlook. And when we started at the beginning of the year, there were a couple of things which we assumed. And in the last 3 months, a few things have deteriorated. For example, while global demand, okay, which was strong last year, we expected it to moderate this year. But looking at where things stand, I think you will see a slightly more moderation going forward. China growth, which was weakening in 2021, was expected to kind of stabilize in 2022. But looking at the COVID crisis in China, which has again erupted, and the escalating trade tension between US and China and the property market, China growth is likely to be probably slower than what it was anticipated to grow. In India too, while private sector capex, you were looking at a revival in the capex cycle at the later part of this calendar year. But in the current turmoil, what we have seen and the uncertainty, our belief is that that could get delayed a bit by another 6 to 9 months or so. On consumption also, I think post the COVID recovery and normalizing things, opening up domestic consumption, especially discretionary consumption, was likely to pick up. We've seen that pick up fairly well, but again, with rising inflation and supply side constraints, we could see that kind of taking time to recover back to its normal trendline growth rate. And overall, I think the biggest negative has been on the inflation front. We would have expected that inflation, which was kind of going rising, and US, as you know, is running at a 30-year high inflation, was expected to moderate down in the second half of this calendar year. That now looks like probably it will be more stickier, and with the commodity prices and other things which have moved up, inflation expectations have probably gone up globally as well as in India. So clearly things have turned slightly adverse in the last 3 months. And as you know, crude oil has touched almost $125. It's around $105. Looking at the current situation and between the between US and with Russia and Ukraine, oil prices are expected to probably remain around $100 for the next 6 months or so. And then probably at the latter part of the year, it could come down below, but it's expected to be slightly higher. And along with that, we've seen the other commodity prices. The commodity index is also up by around 15%. Metal prices are up. So that is going to have some impact on global growth, and we'll see global growth coming up. Also, it will have an impact on earnings as margins come under pressure. And on the US Fed, I think the Fed has been more hawkish than anticipated in the last policy. Powell indicated that he is willing to take faster rate hikes. Again, the key now target is inflation, which is the most important thing which US is targeting over and above growth. And as a result, the expectation of Fed hikes, rate hikes in this calendar year has gone up to as high as around 7 to rate hikes in this calendar year, which means that you will see a faster normalization of the policy rate to the mean level of around 2.5%. And on the back of higher interest rates, expectation of higher interest rates, and the geopolitical risk, the dollar has been a safe haven, and we've seen flight to safety, and dollar index, the DXY, has strengthened, which means there is some kind of a sell-off in the risk assets and poses some risk to the emerging market in terms of the flows. We have also seen some volatility in the currency across the world amongst this backdrop. And the big talk has been about the inverted yield curve, right? Which is the 2-year bond yield, US 2-year and the 10-year difference has gone into negative territory, which foretells normally that you will see a global recession, and that has again been a cause of worry. But here again, let me highlight that this inversion yield curve has not been uniform across the yield curve. If you look at the US 2-year and the 3 months paper, there it is still not inverted. So while there are some probability of a recession, but we've seen that in the past also, okay, where the yield curve has inverted. There are 3 instances in the past where the Fed has managed to do a soft landing. And this time around also, I think looking at the fact that the US economic growth is still fairly strong, the job market is again doing very well. And on the US consumer side, I think the overall saving rates are still fairly high. So they should be able to tide this situation much better. And so our base case assumption is that growth will definitely slow down, but we are not really looking at a recession. I mean, that seems to be a low probability event. On this backdrop, we've seen the global growth estimates probably, I think, with the war in Ukraine still not really coming to an end, and the supply side disruptions. You could see the global growth probably shaving off by around 80 to 100 basis point in this calendar year. With the euro area is likely to be the hardest hit because the sharp increase in the energy prices and the proximity of trade with euro and the Russia would have a larger impact. And consequently, earnings are also likely to get downgraded. So for S&P 500, compared to an expected earnings growth of around 8% in this calendar year, the earnings could probably grow at around 5%, so a 3% downgrade to earnings. So what we've seen is that in this backdrop, clearly things have turned at the margin slightly negative. Even on India front, India's GDP growth, which was kind of recovering well post-COVID, we have seen a good recovery, though we are still in the trend line. I think India is still below its trend growth, okay, which was there pre-COVID. US is now well above the trend line growth, but clearly India was coming back slowly and steadily. We've seen that the third wave which came in, we are out of that, and the recovery is panning out well. Because of the current situation, again, India also be expecting the growth rate. We were early expecting around 9.5% GDP growth in this fiscal year. That could probably slow down to around 8.5% or so. But I think India is structurally now set for growth, which we expect it to, over the next 2 to 3 years, go back to its potential growth trajectory, which is around 6.5%. And the reason for that is that the multiple drivers for India GDP growth, both investments, consumption, and exports, all these 3 levers, we expect that to do better, despite the near-term setback what we've seen. So if you look on the investment side, why we are so positive? I mean, India, in the last 6 years, we've seen investment to GDP has come down significantly, but there are signs of early revival in the whole investment cycle. I mean, government spend continues to remain fairly strong, and in this budget also there has been a big thrust on the infrastructure spending. The housing market in India, after a gap of almost 7 years, is showing signs of revival, again, thanks to the affordability which has gone up, the low interest rates, and the push by the various state governments in terms of cutting the stamp duty has given a boost to the real estate sector, which we think will start to revive. And there is a genuine demand for real estate in India at a right price. And overall, private sector capex, we've seen early green shoots of private sector capex pick up in a few sectors like the metals, cement, and the textile sector. And here again, I think the overall the foundation for capex revival is in place because the corporate balance sheets are now fairly delevered. Corporate India in the last 2 years has really taken the increase in profitability to really delever the balance sheets. And as demand recovers, they are in a good position to really start investing. The bank balance sheets are also fairly strong to start lending. So, and in India, I think the government focus on manufacturing and the PLI scheme, which has been introduced, has seen good traction. We've seen many companies, domestic as well as foreign companies, announcing plans to set up manufacturing base over here to take advantage of the PLI benefits. So investments slowly and steadily, I think, should pick up. And we talked earlier also in the Economic Advisor being positive on the whole capex recovery. Exports have been doing well on the back of the strong US recovery, what we've seen. And going forward, while you could see some slowdown in the global growth, but I think India is likely to still continue to do relatively better, I would say, because A, we are gaining market share. I think the whole China plus policy which is going on, India has been a major beneficiary of that, especially in sectors like textiles, specialty chemicals, in pharmaceutical API. And that will continue to drive exports at a fairly good clip is what we can assume going forward. Also, IT exports, which is more services exports, have shown a very strong trend during the pandemic. I think the full focus on digitization, India is very well placed to capture that. And the order inflows for the IT companies has been fairly strong. And that looks to be likely to grow at around 12 to 13% even in this fiscal year. The third pillar of India GDP is consumption, which has been a weak spot recently because of the COVID. And also the rural recovery has been fairly slow. But here again, I think the overall structural drivers for India consumption to pick up are in place with the favorable demographics, the Gen Z population, which is willing to spend, and the per capita income at an inflection point where discretionary consumption will start to pick up. I think discretionary consumption as a percentage of total consumption, which has already reached around 24% or so, is likely to go up to around 40% by 530. And what we've seen is that overall in India, the trends with the whole digitization, which has happened, and the adoption of digital in the last 1.5 years, a lot of consumers in interior towns and villages of India are also able to really, which are also have aspirations to able to reach out, and we've seen strong revival on the retail side. And another interesting phenomenon which we've seen is India is, I think, the emergence of the whole startup ecosystem in the last couple of years. There's a huge amount of funding which has come into the startup ecosystem, and that is also creating new jobs in the organized sector, which should help to drive consumption. Even the IT sector has been a big employer this year. IT companies will hire almost like 5 lakh new engineers, which would again bode well for consumer, especially discretionary spend. So while consumption will still be slow, and because of the high inflation, okay, in the short term, I think you will see, but I think slowly and steadily, I think we see a revival of that coming through. And as you saw, and luckily for India, I think the whole COVID wave, we have passed through that. We had the least number of cases, whereas across the world, we're seeing in China and other places, again, a rise in COVID cases. And as a result, the opening of the economy in the last couple of months has been fairly strong. And I think that should continue. It's also reflected in the high frequency indicators, which are showing good traction. If you look at the latest GST numbers, which came in, was an all-time high at around 1.5 lakh crores. Even the toll collections at the tollways is also at an all-time high, which shows that there is mobility is again back to its pre-COVID level. And the manufacturing PMI is also showing a healthy trend. While let me caution here that some of these trends could get impacted in the short term because of the supply side constraint, but I think clearly we are on a path of steady recovery is what it foretells. I think while the COVID has, the last 2-3 months, the outlook because of the high inflation and the Russia-Ukraine crisis has been a cause of concern, but I think there is a silver lining over here, at least for India, I would say, is that on the food prices, the whole rural India, which has been going through a pain point in the last 1 year because of the second wave of COVID impacted rural India much bigger. And the government really support last year in the budget was not much for rural India. So we've seen rural consumption slow down, which has been reflected by the commentary from the two-wheelers industry, and also for the consumer staple companies have been commenting on that. But I think there is a ray of hope over here. I think we expect rural consumption or the rural India to do well next year because, as you know, food prices have gone up, and India, luckily, except for oil seeds and pulses, is self-sufficient in food, and we are in fact exporter of wheat. So the higher food prices and consequently higher MSP prices also would mean that the farm incomes, next year in the Rabi and the Kharif crop should be good. Cotton prices also in the cash crop have gone up by around 50%, so that should also help. And the good thing is that the reservoir levels have been fairly good, and monsoon indication is also normal. So I think if rural India is able to recover and come back, I think that will again aid India's recovery and the consumption going forward. India again has been benefited by the to some extent by the anti-China sentiments, and initially it was the US trade wars, but post the Russia-Ukraine crisis, I think China, with his more support to Russia, is likely to be de-alienated by the foreign world, and increasingly investors are looking to shift out of China, while other Southeast Asia, Mexico have been the favored destination, but India is also now getting investments. And considering the fact that we've seen big reforms in India in the last many years, a lot of the infrastructure bottlenecks which were there, and also the tax reform which have helped now global investors to really look at India as an alternative. And India also has a large domestic base to really cater to. So it becomes a natural choice for somebody who wants to set up a large manufacturing base in India. So some of these things are the silver linings amidst the current backdrop, which looks fairly gloomy and negative. So I think there are structural drivers in place for India is what the limited point I wanted to make. And even on the macroeconomic stability, I think India is now being able to do much better in terms to withstand any external shocks. And we've seen that this time around compared to FY13 when we had the taper tantrum, and when there was a commodity shock and oil prices shot up. This time around, if you look at, we are in a much better situation. While the CAD this year, because of the higher crude oil prices, would be around 3% or so. But if you look at short-term external debt to GDP, we are much better placed than what we were in the past. And that has been, I think, good. I think India has never really borrowed too much of external debt. And that is helping during this period. Also, our forex reserves have been fairly comfortable. We have accrued that in the last couple of years. And we are setting on almost like 1 year of import cover, which is also comfortable, much better than what that was in the past. And inflation, if you look at earlier, when we had such kind of situation, was much, much higher. This time around, India CPI inflation is much controlled at this point in time. And I think and that has also been tested. I think we've seen this time around, even with oil shooting at around $110, $120, the rupee has been fairly stable. If you look at in the earlier crisis, whether it was the GFC or the taper tantrum, we have seen a sharp depreciation and the volatility in the rupee. But this time around, during this period, the rupee has depreciated by just around 2.6%, and the volatility has been the least. I mean, that shows India's resilience, and India has really come of age. and especially for an emerging market to show that kind of a resilience, I think that gives a lot of confidence even for foreign investors who want to look at India from a long-term perspective. Coming back, how does that really foretell for corporate India? So if you look at corporate India, I mean, in the last 2 years, despite the fact that the overall GDP growth was negative because of the COVID crisis, but actually this is the time actually where we've seen corporate earnings growth in the period from FY19 till FY22 has actually been higher than the long-term average what we've seen in the last 10 years, right? Around 15% or so. And we expect while this year in FY23, we were early expecting the Nifty earnings growth to be around 17%. We could see some 3-4% downgrades to that. But still, we are looking at a fairly strong earnings growth in the next 3 years, driven by, again, as I said, domestic recovery, and also the fact that a couple of sectors like the banking sector, the IT sector, the infrastructure sector, the capital goods sector is likely to see a strong revival. So I think overall corporate earnings growth over the next 3 years, we think can still grow at around 13 to 15%. There is enough room for corporate profits to reflate because in the last 5, 7, 8 years, we've seen corporate profits to GDP had come down significantly. And with various sectors, domestic sectors now firing, earnings growth should be fairly decent. And valuations, where they stand at this point, that has been, the markets had rallied ahead of the fundamentals because of the large amount of liquidity push what we've seen in the market, and the multiples were trending higher. Now with earnings catching up and growing strong and a slight correction, valuations are now slightly above the long-term average. If you look at in terms of price to earnings multiple, on a price to book value multiple, it will be around 8-10% higher. So the valuations are not cheap. It's slightly expensive. And to that extent, I think as the normalization happens in the policy environment, I think you will see P multiples would also normalize over the medium term, and that's what our view is. Overall, on the liquidity side, FI flows have been large sellers in the market in the last 6 months. We've seen almost $18 billion of FI outflows since October. Again, that is on the backdrop of the global situation, what we've seen, and also the fact that Indian markets were relatively looking expensive. But I think the good news is that the domestic inflows have been fairly strong to really balance that. And as a result, we've seen the markets have been fairly steady. Here, I would say that with the large amount of selling, what we've seen on the foreign flow already, and the fact that the India's overweight, which was there into the emerging market funds, okay, that has come down. And we haven't seen these kind of large outflows in a calendar year. So I think once the dust settles down on the global front and things normalize, we would see FIs again coming back, because I think India is the market which still really holds structural long-term growth story. And also within emerging markets, what has happened is that if you look at Russia, which is now totally out and not investable, China, which looks attractive, but China has seen a lot of volatility, and with the Chinese policy measures, okay, which have been impacting growth and the whole meltdown in the China tech space, investors not really comfortable looking at China, even though valuations are attractive. And other markets like Brazil, which is more commodity linked and can't be looked at from a really long-term perspective. So India really default becomes a natural choice if somebody has to really take a longer-term view. So we would expect the FIs flows to, and already we have seen in the last couple of weeks that the intensity of FI selling has slowed down. And domestic flows, I think I don't see any reason for that to really come down. And large amount of flows have been coming in from the SIP route. And the good news is that India, we've seen the penetration of the flows has now increased. There are a lot of new investors which have come into the market in the last 2 years. That has been also reflected in the secondary market, in the opening of the demat accounts, which we have seen. And the ownership of equities of India is still very low. I mean, it's gone up from say around 3% of your savings to around 5%, but it's still way low. And I think looking at the alternatives, I think you would see equities will continue to see the flows what we have seen in the last 1 year. So overall, on the marks, to summarize the market outlook, I would say that I mean, the recent uncertainty, which is because of the war-like scenario, the high inflation, sharp expected increase in interest rates has taken center stage, and it is likely to lead to more volatility in the markets as we have seen in the recent times, and that is likely to continue. Also, the global overall growth outlook would see some moderation and some downgrades. Even earnings could see downgrades in this calendar year. But I think from India perspective, I would say that the structural drivers are very much in place. We could see some normalization, okay, in terms of the overall valuation multiples going forward. But I think with the three pillars of India's GDP growth improving going forward, we think that corporate India earnings growth of around 13 to 15% over the next 3 years is quite possible. And even if we assume some derating of multiples, I think market returns can be a tad lower than the earnings growth going forward. So that still makes equity as a reasonably good asset class to invest going forward. And I would say for investors to really stay invested, there is some amount of risk in the shorter term. One can expect some correction from here. We've already seen some around 12-13% correction in the last 3 months. But I think this correction should be used as an opportunity really to dip into to really benefit from the long-term structural story. I would like to highlight here that this year the market is going to be much more discerning and is going to price in risk much better. You will not see everything going up like we saw in the last 2 years. Companies where earnings growth and visibility is stronger, I think they will do well. And it's in that sense will be a more stock pickers market. Overall market returns in this is, I think one should look at this year as a kind of a pit stop in the longer race what we are into. And markets will probably consolidate this year. But the long-term returns still look fairly strong. In terms of where to invest in this current environment, on the equity side, I would say that large cap would continue to be favored at this point in time. So we would recommend around 25-30% allocation in the large cap funds. Current uncertainty we've seen during the crisis also, the large cap companies have been able to manage their margins and overall profitability much better, and that will continue. But a larger allocation should be towards a diversified fund which can play across the large, mid, and small cap spectrum and do that well. So 35 to 40% in a flexi diversified fund where we have funds like a flexi cap fund, the large and the equity advantage fund, which is a large and mid cap fund, the multi cap fund, and even our recently launched ESG fund, where we have seen the world is now really recognizing ESG as a big theme, and companies which are really following that are getting rewarded. Mid and small cap space, we still like it from a longer term perspective, given the fact that a lot of these companies are dependent on domestic recovery, and where we are fairly positive from a next 2 to 3 year perspective. And one can continue to make the target allocation of around 15-20% towards a mid cap fund. And in thematic categories, we would recommend the banking and financial services funds. I think the whole banking sector is likely to benefit from the recovery in the economy. The credit growth is likely to pick up, and with the whole NPA cycle kind of bottoming out, we should see a very good growth in the banking and financial services side. And apart from that, the whole consumption theme, which is a long-term and structural in nature, and as India opens up and as the penetration increases, that will be a good structural story to play, and that can be played through our Gen Next fund. Also, we are seeing a lot of new companies coming in the IPO market in the consumer space. These are good niche companies, and one can participate that through this fund. And finally, the whole digital theme, which has played out well in the last 2 years, last 3 years, we expect that to continue. It offers good visibility of growth, and it's a trend, I think, which will continue to do well going forward. Apart from that, I think in the current uncertainty for investors who wanted to come into the market and decide how to do it, the Balanced Advantage Fund would be a great fund to really come into. And also our asset allocation fund, which you will hear more about in tomorrow's session. I think these are the two funds which, especially for a new first-time investor or investors who are looking to really look at, besides investing into debt and looking at slightly better returns but lower volatility, I mean, these are the funds which definitely one can look at this point in time. And the larger themes which look to be of interest to us, we shared this during our annual outlook, which remains the same. The banks, the banking and financial services sector, which I talked about earlier, valuations there are still reasonable compared to the long-term averages and could be a good play to play the whole India growth story. Real estate sector is looking to revive. We have seen the whole low interest rates, affordability kind of tailwind which are falling in place. The inventory which was there in the whole system is also now coming down. We have seen good absorption of that. And I think one should see steady recovery in the real estate. We've seen a good amount of consolidation also for the organized player, which should benefit. Consumer discretionary, especially the small ticket consumer discretionary, as a structural theme to play, I think, for India for the next decade, that continues to hold true. And the whole manufacturing, the sector and the private sector capex recovery is a theme which I think will play out over the next 3 to 4 years. And the digital transformation. These are the 5 themes which will continue to do well in the coming years. Finally, I think while equity would still be an asset class or a longer term which gives good returns, but as we enter into a period with high volatility, I think it's important to really focus on the asset allocation and have the right asset allocation to reduce the volatility. Amongst the various asset classes, what is our outlook over here? So gold has, I mean, given not too great return in the recent, only in the last couple of months, we have seen gold prices go up. But I think amongst the current uncertainty as a safe haven and in a period of higher inflation, I think gold could still do well and can be considered as a part of the asset allocation. One can expect high single-digit returns over the next 1 year. Bonds have not done that well in the recent past, and looking at the interest rates are still low, and we are in a phase where we will see interest rates move up. Bond prices will remain under pressure. So the next 1 year, I think the returns there would be muted. I think a year down the line, I think once interest rates normalize, I think one can look at the debt funds. Finally, property. Again, property prices have, in the last 7 years, have been fairly flattish. We've seen revival over there, some increase in property prices. And as demand picks up, I think property returns could be in the mid single digits is what we could expect. Equities, as I mentioned earlier, this year would be a year of consolidation. Don't expect great returns, but over the next 3 years, I think earnings growth in the 13 to 15%, and returns could be slightly lower than that. So I think the current high inflationary environment, I think equity still remains the asset class of choice from a longer term perspective. And one should not really lose sight of that despite the near-term volatility. So with this, I would halt here, and I think, Avni, we can go ahead with the Q&A.
Absolutely. Thank you so much, Mahesh. It's been very insightful. You've covered pretty much every topic. So there's a lot that I would like to discuss as well. So let me begin by just talking about the overall market then, Mahesh. You know, we're close to all-time highs. And the last time we were at these levels, you had crude at close to 74. There was no war in the world. The Fed was not supposed to be hawkish. But now the scenario has completely reversed. It's been the complete opposite on pretty much all of these pointers. So what do you think explains the euphoria in the markets?
Yeah, so as I explained earlier, I mean, clearly things have turned a bit adverse than what they were 3 months back. And I think markets are still looking to look beyond, okay, the near term. And while there are talks about slowing down, growth slowing down, but I think the overall longer term, especially for India, I would say, I think the long term growth trajectory potential for India is something which is investors are probably looking at. And while we have seen that liquidity and this thing has kind of slowed down, but I think the alternatives are not really much. And in a period of slightly higher inflation, I think equities tend to do well. So lack of alternatives of where to invest, and the fact that the current situation, what we have seen, if that de-escalates, especially the war situation, then you could see things normalizing very fast on the high inflation and the commodity prices which have gone up. So I think that is what is keeping the markets where they are and being so resilient. But that doesn't mean that you can't see a correction. I think one has to be cautious. I think we are cautious while we are positive from a medium to long term perspective, but near term we are very cautious at these levels, and investors should expect some correction. When to what extent, very difficult to foretell.
Fair enough. And I want to just take off about the earnings. You flagged off that, there is that commodity price inflation, there will be earnings downgrades, but still you remain fairly positive on earnings. So over the long term, of course. So given the fact that the kind of commentary that we've been getting from some companies, they are indicating that the commodity price inflation is real, it will eat into margins. What is it that you believe we are likely to see in terms of earnings growth?
Yeah, so I think you will see a few sectors and companies where the impact on inflation has been much higher. And in the current environment, it's not possible to pass on that full price increases, right, to the end consumer. It has to be taken in steps. So the next couple of quarters, you would see that impact, especially in the auto sector, probably even in the consumer staple consumer durables space, where the impact could be larger. But overall, on the earnings front, I think there are a few sectors, whether it is the energy sector, the commodity sector, where probably, I mean, the impact will be slightly positive. Even large sectors like banking, for example, we don't see any major impact on earnings. Overall credit growth, in fact, a slightly inflationary environment means that the credit, the working capital requirements will be higher. So you would see a better credit growth over there. The yield curve in India is still not inverted, it is still steep. So that's good for the banking sector. So banks' profit should be fairly good. And we're not seeing much stress on the retail balance sheet or the corporate balance sheet. So given that, I would say there are a few sectors, yeah, where there could be downgrades, but on balance, if you look at an aggregate basis, we are not really seeing, except for a 3-4% downgrade, we won't see too much of an impact over there. And as see, India, the rate of recovery has been very slow and gradual, and the opening up, which has only just started, okay, to play out, as that gathers momentum, you would see the top line growth, which was a big challenge. I think that will also slowly start to improve.
Mahesh, you did touch upon the theme of digitization in your presentation, and it's ever so crucial. Look where we are today. We're doing an entire conference via Zoom, everyone sitting remotely. Let's understand some of these new age tech companies that thrive on this theme of digitization, and how you expect investors, especially a lot of these new age investors, to approach this theme.
So I think India has also seen all these new age technology companies. I mean, they have been thriving in the private space. We have seen some listings coming in recently, but recently, because of the global sell-off, okay, we have seen a sharp correction and volatility in these stocks. But I think they are here to stay, and the digital transformation, what we've seen, is across the board. India has also adopted digital much faster, and I think the penetration of mobile data in India has really helped that. And during the COVID, we have seen that adoption. So I think there is disruption, okay, which is like to happen across sectors, and the existing incumbents which are able to adopt digital fast and quickly, I think will continue to do well and survive. And some of the new age technology companies will gain market share. I think here, by investing in this space, what we really look at is companies which have really established proper model in terms of profitability, and have the unit economics in place. So while they might currently be making losses because they're investing for growth, but the road to profitability is in place. I think such companies, I think we definitely will look at from a long-term perspective, and also companies which have already established leadership in their segment, because this is a space where companies will continue to fight and burn money, but companies which have established leadership, one can be pretty sure and have got capital, okay, enough capital. I think they will they'll survive and continue to grow. So I think it's still early days. There'll be a lot of volatility over here. A few companies will fail to really meet the expectations. So we are really approaching the space in a kind of dipping into that space, not taking a very large exposure, trying to understand and see which companies, okay, as we track their performance, okay, which could continue to gain market share, because the opportunity size is big, where the target markets are very large. And as we work along with these companies, and as we gain confidence, we would increase exposure in some of these new age technology companies.
Okay, that's a word coming in on new age tech. And incidentally, today it was in focus when we saw it at the other end, where Zomato and Swiggy were facing some outages, but that's part of life, I guess, Mahesh. I also wanted to talk about your outlook when it comes to the liquidity situation. You did say that when the dust settles, in particular when it comes to the, the very the geopolitical tension, that we will see FIIs returning to the market. So you're confident that India, in terms of the entire emerging market basket, still has a favorable place when it comes to FIIs?
Yeah, I think if you look at in the last 15 years, right, there are only, global financial crisis. After that, we've seen a calendar year where FII flows have been negative. Last 6 months, we have seen large amount of outflows, again driven by what's happening globally, and the concern. The outflow from the emerging markets. But I think India clearly, I think, has shown, I think, especially during this turbulent time, okay, has shown a lot of resilience on the macroeconomic side, and also from the stability overall in terms of the currency, which has been fairly stable. And I think in the emerging markets, as I mentioned earlier, China, which is a large part of that, right, it's almost 30% of in the benchmark, more than 30%, is a market which has been fairly shaky. Overall economic growth in China is likely to slow down. They're struggling over there in the property market. And given the policy flip-flops over there, I think the confidence for investors is not like much. So India, by default, becomes a market which one would want to really play from a long-term structural perspective, where the drivers are in place. Even in terms of growth, I think amongst the large economies, I think India would still be the fastest growing economy. And even in corporate India, I think India has got much more diversity. It's not only commodity focus or focus only on the financials. So I think given that diversity and the structure, I think I have no doubt that foreign investors, okay, will come in, and India will remain an expensive market, right, because of better growth dynamics. India's multiples, okay, or the premium which is there compared to the other emerging markets, okay, that will continue.
I want to also take some questions that our viewers and participants are sending in to us. And it's actually two questions which have come on the same sector, and one sector that's been hot off late, owing to the consolidation that we've seen with the HDFC twins. There's two questions on the overall banking sector. They say, Josephine asked that it's taken a huge hit. Do you think that we will see a turnaround with the current economy? And what's your outlook as well, Mahesh, on the big news?
The banking sector, if you look at the current numbers, I think we are seeing credit growth starting to pick up, which is good news. Last year, okay, we had seen mid-single digit kind of growth. And overall on the asset quality also, after the COVID crisis, we've seen now things starting to improve. Hopefully we are out of the lockdowns, so one should not see any major challenges over there. And overall bank profitability, I think in terms of earnings growth also, if you look at next year, are showing a healthy trend over there. So I think the banking sector by and large should do well. Within that, banks which are have very well capitalized, I would say, and are also focusing on digital, because we are going to see disruptions over there from the new fintech companies which are emerging. Still early days, but banks which are really equipping themselves really to not only enable themselves for having a secure digital future, but also give competition to the fintechs, I think will continue to gain market share over there. So I think, and again, in the valuations, if you look at in the banking sector, I think we've seen some underperformance recently because of the global crisis. Okay, whenever there is a risk off, we see the banking sector get sold off. So the valuations are fairly reasonable compared to the long-term averages. So the risk reward there looks fairly good for us. And I think, yeah, I mean, we have a positive view on the sector, and we expect it to do well across this cycle.
Thumbs up there coming in on the banking sector. I'm going to take on board another question then from one of our viewers. Mr. Surendran says that with the influx of new investors chasing leading names, don't you think that these so-called giant names are now highly valued? How do you justify the return on investment? Mahesh.
Again, that's a very relative question. I think it's stock specific. I think the larger cap companies or the leading companies which are strong in each segments, and they will continue to find favor with investors. But what we've seen is that even during the last 2 years, the larger and the bigger companies have become bigger, right? And that trend, I think, will continue, especially during times of crisis. We see there is a more consolidation which happens in the industry, and the bigger and the larger companies continue to gain from that. So they will be expensive. Obviously, one has to really look at in terms of where the risk reward is, in terms of the growth and the valuations. But I think the larger the leaders in the space will continue to command a premium, is what I think. And one has to really look at really in terms of where the valuations are compared to their historical levels, and then take a call on these names. But I think it's better to be in this current market environment where there is uncertainty, at least in the near term. It's better to be in companies where there is much more certainty in terms of the earnings, and that's where I think some of the larger names, I think the leaders, I think, would offer that.
Earnings visibility is crucial. Mahesh, given that the market price is a function of EPS and PE, we've seen the PE rating that has taken place. EPS, if at all, because of margins, inflation, and even demand pressure could come under pressure. What is the outlook in terms of returns that we're expecting? If we're not going to see EPS go higher and PE come down, how do you expect the return metric to play out?
So as we mentioned earlier also in Outlook, that this year of multiples because of the headwinds what we are seeing, rising interest rates and higher inflation, and also lower liquidity, global liquidity, I would say. Earnings growth, I think, would still be fairly fine in the double digits. So as a result of that, I think because of the normalization in this year, I think the returns will be fairly muted. I think, as I said, this is a year for consolidation. Don't expect any great returns. But I think as the earnings trajectory continues to play out over the coming next 2 to 3 years, I think that's where the market returns would be. And that's why we said that the overall market returns will be slightly below the earnings growth if I take a 3-year view.
Mahesh, it's always been a pleasure interacting with you. Thank you for being so candid and elaborating your outlook on the markets, the CapEx theme, the macros, as well as individual sectors. Thank you.
Thank you.